I was fascinated by your synopsis, really, of last year, Amy. I don't understand why the worst trade was puts and one of the best trades were selling calls selling puts, which is weird, I guess, because it was such an orderly decline. And as a result, people have that muscle memory and aren't hedging right now for downside, which is possible.
Yeah, that's exactly right. It was a really counterintuitive market. You know, it burned a lot of people because we had the S&P draw down 20%. And the only option strategy that did worse than that was you're down 20% plus owning your puts. And so, you know, it's sort of boy who cried wolf, right? Everyone who wanted to hedge last year got burned. And even if we're setting up for maybe kind of a dark market, that positioning is just not there, Joe. People are not hedging. They do have that muscle memory. And, you know, and it kind of kills when the thing that did the best was actually selling puts to own calls. That was up 1.22% compared to the S&P down 20.
That's weird. So you raise some premium selling the puts, and then you buy calls, which you're betting on something going higher. I don't know why that would have worked since nothing went higher. I guess it did a little bit because it was in a trading range. As far as not making money long puts, was that because there's obviously it only lasts so long when you buy an option, so the time premium is always kind of expensive. So if it didn't go down quickly enough, you didn't make any money. Is that what happened?
Yeah, that's exactly right. I don't have a great technical term for it, but essentially we lost some of the gappiness that we got in 2020 or 2021, right? We didn't get those sharp moves down, which is really a boon to options. Instead, we got, you know, a relatively orderly drawdown. If you look to last March, it was kind of a grinding market. It went, you know, down slowly and then it went up slowly. And unfortunately, options really is all about timing. It's all about those wild swings that you're actually looking for. So that really contributed to the path that we saw last year.
For whatever reason, you think it's going to be gappier this year in terms of more, I guess, and we had some people on yesterday talking about VIX, VIX at much higher levels, which I would think would require some serious breaks or gappiness to get that type of volatility. And you're lending credence to that notion that we see some of that this year.
Yeah, you know, that's part of my outlook for 2023. One thing, just one simple thing I say is if you think about where investors stood at this point last year, you know, there was almost universal consensus that we were going to lift off. So in one sense, that path was actually far more predictable than where we are now, where we have had liftoff. And really the debate is, you know, how much more there is to go, when will cuts start. So I think that uncertainty is higher for the path. And then second, you know, we're starting to see those cracks in other markets. We're starting to see, you know, people play downside in leveraged loans and high yield and credit. Those bond proxy ETFs that we watch on options are extremely expensive. People are focused on it. And, you know, that contributes to the gappiness, if you will, that'll kind of cause that volatility floor to remain quite high.